what is this ESOP alternative and how does that work within the structure of these transitions? And we kind of summarized it in 3 different areas. So as we've been talking about, this is an ownership transition tool. And it really is, when you go into an ESOP transaction, there's a lot of benefits in which the selling shareholder really stays in control, stays involved in the business, and we encourage that for a successful ESOP. So if you're looking to sell your business and exit in 6 months, an ESOP probably is not the right alternative. I never say never, but probably not the right alternative for you. So as we look at this transition, it doesn't have to be a full transition to 100% owned ESOP. We're seeing much more of that today because of the S-Corp ESOP tax benefits, which we will go over. But you don't have to jump in with both feet. ESOPs are not intuitive. You can't think your way through them because you're working with something that is regulated. So the learning and education phase, which is I think why the 3 of us are so passionate about educating the business owners about ESOP alternatives, is there's a lot to learn. There's a lot of different facets to it. So what happens is a trust is formed, and that is your buyer. So when you're thinking about, as we said, this is a transition, so there is a buy-sell transaction that is going to happen. The selling shareholder is selling his interest to the trust, which is represented by the trustee. And we'll show you who all the parties are involved. I like to quote that it takes a village to make an ESOP transaction happen, and that can be a little daunting as well. But we want to do this for the right reasons, for the right company, and get the right results ultimately, so that the business is successful in its transition to this capital structure. And the other thing is, and again, you're talking to some finance and accounting lawyer people, but it really is also about culture, understanding the culture of your organization and how that plays into what you want to accomplish with the ESOP, which is why I constantly am going back to those goals and objectives. If you're a very private person, you do not want to share information, you do not want to put information out there that talks about the value of the business and how value is created, you will not get the ultimate benefit of the ESOP to those beneficiaries, which are all of your employees that helped you build your business. So understanding where you're at on that continuum of whether you call it open book management or just a shared vision and culture needs to come into the equation as well. The second part, as I mentioned, this is regulated, so it is an employee retirement plan. When you think about if you have a 401k plan, a lot of the design and regulations and stipulations of how a 401k plan is set up, they parlay into the ESOP and the rules and regulations that you need to follow. So yes, there's going to be these great tax benefits, but the IRS doesn't just give away those tax benefits. They want to make sure that those participants are protected, and they use ERISA to do that. And those participants are represented by the ESOP trustee. As we mentioned, that trustee has a fiduciary responsibility to be in the best interest of the participants of the trust. So again, it creates a new governance and a new way of thinking, but the trustee is not there to come in and run your business. You as the selling shareholder can still remain the CEO, can still be in there making your day-to-day management decisions if you so desire, understanding what you want to do with your next level of management, but the trustee is there as a representative of those participants and to understand the value of their investment in your organization. And then ultimately, as we think with retirement plans, employees do retire, hopefully, someday, and there has to be a liquidity event for those employees. So that's where the second kind of piece of the liquidity happens here is the company is obligated to provide liquidity to those employees as they exit the ESOP to give them cash in exchange for those shares so that they can then move on into retirement. So that is the other protection provided to the participants. And then the tax-efficient leverage buyout, which Matt was eloquently describing. So there is tax deductibility. So in an organization, when you're making the debt payments to pay off the debt related to the ESOP loan, those are tax deductible. So effectively, you can be making payments to the bank using pre-tax dollars. So, or I call them 66-cent dollars. assuming a tax rate of approximately 44%. So that can be very, very beneficial when you look at ultimately then the tax strategies and tax dollars that are going to exit the company. They're actually going to help you be bought out of your organization versus going to Uncle Sam. And then as someone coined the phrase, the nirvana of ESOPs is the 100% S Corp ESOP, and we will go through some of the benefits of that. But essentially, to steal the thunder, it's you end up with an organization that pays no, I will say federal taxes. There are certain state taxes you are still subject to based upon the state, individual state tax laws. But to think about an organization that can now take those 44 cents and put those either to pay down the debt, to pay your retirees, to grow your business. There's a lot of things that can be done with that extra cash flow if you decide to go 100% S Corp ESOP. And then, of course, if you stay a C corporation, there is the opportunity as the selling shareholder to take those funds and do what's called a 1042 transaction and get deferral of those capital gains. And in the ultimate play would be then ultimately to 100% defer those gains upon the expiration of your estate plan, which I assume people know what that means, and that your assets are able to pass on to your heirs at a step-up in basis. And so you could have a strategy that ultimately results in 100% deferral of that gain.
Which is why your estate plan and your exit strategy need to work together.
Absolutely. So when we think about the structure in the ESOP world, it does take a balancing act, and there's a lot of different pieces and parts that come into play. So when I look at this, we have the company kind of in the center. You have your seller and you have your buyer. And so when you think about from the company's perspective, we need to understand how much debt can the company take on? How much will the bank come to the table to help us enter into this transaction? The debt transaction is really a cash flow, understanding what the cash flows of the business are. Because if you think about it, if you're going to go take a loan out to buy a piece of machinery in order to expand your business, that's a productive asset. That's an asset that then hopefully is going to generate more revenues for you. When you take on this debt, it's a capitalization transaction in which that cash exits the business to go to the selling shareholder, and now the cash flows have to help fund that obligation. Understanding and managing the seller's expectations. Does the seller, as the selling shareholder, do you want all your cash up front? If you do, that's more in that third-party sale, because that third party has to go out and obtain that debt and work through that so that the seller can walk away with all of his cash today. And if your goal is to absolutely maximize value, probably not an ESOP, but yet the ESOP will be a fair value. It will be a fair purchase price. So understanding where you sit on that continuum. Then looking at who's going to run the company post-transaction. As we said, the CEO can stay in place, can continue to run day-to-day management decisions, but understanding how you want to grow that management team that you have to ultimately take over, because ultimately that's for the selling shareholder. You've taken some chips off the table and go back to your goals. Do you want to go sit on the beach? And that might be one option. You might want to travel, or you might want to stay in your business day-to-day until your estate plan expires. I also throw board composition and governance, and this has been a neat thing that I've really observed as companies move through the maturity of becoming an ESOP and then the maturity cycle once they are an ESOP. Much more board governance, getting maybe outside members onto your board to add some discipline and add some structure to how the board works can be really helpful to the company, and I definitely see that happening in our ESOP companies as they mature.
And I often compare ESOP-owned companies that are using good governance for an ESOP to a publicly traded company. It's not quite the same, but the governance structure ought to be pretty close to the same, because while you don't have the public owning shares in your business, you have employees who are beneficiaries of the ownership of your business, and so you have obligations to folks to operate in the same manner or similar
manner. I use that same example, Chris. That's a good one. And so the person that represents those investors is the trustee, and again, the trustee is concerned with their investment. They're not they're not there to run your business or tell you how to run your business. They're there to understand what your plans are, how you're going to grow the business, and how ultimately that impacts the value of their investment. So that's where the trustee's focus is. And you hear this over and over in the ESOP transactions. The trustee cannot pay more than the fair market value for their stock, and Matt's going to hit a little bit on valuation, so I won't go too far into that at this point. Items to consider when you're actually going through the structure of the transaction, and having a financial advisor that understands how all these things interact and what's coming down the pike in an ESOP transaction can, number one, save you dollars, to be honest, because if they know what's coming, they can anticipate and help the transaction move along, but can also provide you great advice along the way. So understanding minority versus a control transaction and what that does to valuation, the implications of that. And then also, you know, it's one thing if you're the founding member and you own 100% of the stock and you're entering into this transaction, or as Matt mentioned in the family, I definitely have seen other transactions where we have, you know, 20 or 30 individuals that own stock, and now we're going to look at an ESOP transaction and how to get all of those players. Are we just going to buy out the minority shareholders? Who's all going to come to the table to sell shares into the ESOP? Financing. My biggest comment on financing is talk to your bank early in the process, understand what you can do from a financing perspective, what your bank's willing to do, because that could be a deal killer. Not from your list of deal killers, but if you can't get the financing, knowing that the seller potentially is going to carry some of that debt themselves, but probably doesn't want to carry 100% of the debt themselves. We're in a different age than we were back in 2009 to 2010 when we did see sellers carrying 100%, but with the bank financing, understanding how all that comes together. Then you would move into the ESOP features, and that's really the design of the ESOP. There's a ton of flexibility, but understanding what your goals are within the ESOP now and what the benefit is you want to provide to your employees. We talk about the internal loan, and we haven't really gone through structuring of an ESOP, but there's the benefit that the participants get on an annual basis is directly correlated to the amount of contributions that the company is going to make into the ESOP, which correlates to the deduction that you get for your taxes. So going through that session and understanding the different design mechanisms that you can select, and that really does also fall under that ERISA umbrella, and what can we do under ERISA is how we help design the ESOP. But the other factor I do want to say here is the eligibility. So as Matt mentioned, you can't restrict individuals except in certain situations like a leased employee or non-resident alien, things along those lines, again, what ERISA lets us do. So if somebody meets the criteria, which is typically, I think what everybody sees is 1 year employment, 21 years of age, can adjust off that, but let's just use that as a kind of a baseline. If an employee meets that eligibility, they are in the ESOP. It's not, the employee doesn't have the option to in or out, they're in the ESOP. And then other transaction features, and again, we won't go into, I think this leads us into an advanced session after this one, I think, is what I'm hearing as I'm speaking here, is understanding the other compensation factors that have to come into play with the ESOP. The ESOP is your long-term incentive, salaries and bonuses are your short-term. Well, there's a lot of things that probably need to be addressed, especially for your key management in midterm compensation. And so we're seeing synthetic equity and warrants that are part of these transactions, both for management and the selling shareholder. And then the tax treatment, which is what I really want to get to here, and I'm starting to talk pretty quickly as I see the clock ticking pretty quickly on us. So as we talk about those tax incentives, you have to separate into the C corporation versus the S corporation. And within the C corporation, the tax benefit really is focused on the selling shareholder first, and whether they want to do that 1042 election. And what that means is if you make that election, you sell your shares and you get proceeds. Then you take those proceeds and you reinvest those in what's called qualified replacement property. And the easiest way to think of that is you go to the stock market and you buy individual stocks and bonds. You build that portfolio and you leave it with an investment manager and you can't touch it. It sits there, and as long as it sits in that account with the investment manager, you do not pay capital gains on the transaction you just did between the company and the ESOP and yourself. At the point you touch those funds, that's when you pay capital gains as you, the selling shareholder, which is then why we say is if you have wealth outside of the business and the business isn't your sole source of your liquidity to fund your retirement, that's where this 1042 can become really advantageous into ultimately never paying the capital gains on the company ESOP transaction. You're not required to do 100% of your proceeds. You can do a certain percentage of your proceeds into the 1042. So if you want to take 50% of the proceeds and use that to live off into your golden years, that's acceptable. But the stipulation in order to make this election is 30% of the company has to be owned by the ESOP. You have to get to that percentage in the initial transaction in order to make that election. I think that kind of hits the highlights on that.
Yeah, I think and to that point, 30%, that's 30% of the company. If you have 3 shareholders and they each want to sell 10%, right, they can all take 1042 as long as the company is selling 30% to the ESOP.
Thank you, Matt. Thank you. So then what if you're an S corporation? And I guess I should put a caveat in here. If you're an LLC, LLCs are not an acceptable entity structure for an ESOP, so you would have to go through some type of a restructuring to get to a C or an S corporation.
Another topic for a more advanced.
More advanced topic, there we go. So within the S corporation, if you think about it, the ESOP now is a shareholder. When you go to do your tax return, you get K-1s out of that. Well, the ESOP holds whatever percentage of the company that they do, and they get a K-1 for their percentage of the company. Well, that K-1 goes into a trust, which doesn't pay tax. So that's the tax shield that's afforded to the company under an S-Corp scenario, which if you take that all the way up to 100% S-Corp ESOP, a K-1 is produced, but that K-1 goes to a trust that doesn't pay tax, so therefore the company has no need to make any type of a tax distribution to cover a shareholder's taxes in that situation. Woohoo! That's the exciting part. If you are a partial S-Corp ESOP, then you do have to deal with that. There's still the requirement to make pro rata tax distributions if you're required to do so. But if you make distributions, they're required to be pro rata. Let me say it that way. So if I have a 40% ESOP and a 60% is held by a shareholder, that shareholder still has to pay taxes on 60% of the profits of the company. And if we're going to give them the cash to make those tax payments, we also have to give the ESOP 40% so that all the shares are getting their pro rata distribution. So cash management becomes very critical in a partial owned S-Corp ESOP. Now you can use those proceeds to help pay the debt, but you have to understand how all the interplay of that takes place.
And I'll pass it over to Sandy to talk about financial affairs.
Yeah, seller preparedness is really key, Chris. I mean, you can spend the time up front putting your ducks in an order and finding your own skeletons first and knowing how to answer those. Again, whether it's a third party or an ESOP transaction, you'll be able to get through those issues and not have surprises, which nobody likes surprises, especially in a transaction. And from the financial perspective, whether you have audited or reviewed financial statements, knowing that your financials are in good shape, understanding fluctuations year over year, the financial trends of the company, understanding any contingencies that you have from a financial perspective, understanding, your tax returns and what has gone on there, and then as well just understanding the tax implications, as we've mentioned a number of times, both for the company and the individual prior to the transaction, because that can have a significant impact on your negotiating, knowing what those final proceeds are. Again, back to what Matt said at the very beginning, what based upon the tax structuring, what cash am I going to take home? And you can accept a lower valuation if you understand what the tax implications are potentially.
Mm-hmm.